Okay, good morning. We are going to cover Chapter 8 today. Chapter 8 is a very, very short chapter. There are 2 homework problems in Chapter 8, very quick, and I wanted to talk in general about where we're going from here. So we are going to cover Chapters 8 through 13 before finals week. But each chapter, very few of those chapters are covered in their entirety. There's entire chunks of the chapter we're leaving off, like Chapter 8. Very, very quick chapter to do. We'll start Chapter 9 on Wednesday. We may or may not finish Chapter 9 on Wednesday. So know that even though it looks like a lot of the chapters from here on out, these chapters are very lightweight, so we can get through a lot more. Okay. You can see Haley's in class today. Brian is not, so Haley's going solo, kind of. Brian's online at home. So good morning, Brian. He's excited that he gets to sleep in once in a while. So what's due this week? So Saturday we have the attendance quiz that covers today and Wednesday and Chapter 8 homework. Chapter 8 homework, very, very light, shouldn't take that long to do it all. We will cover it today in class, so you'll be all set to get your homework done starting today. Sunday there's a video quiz over Chapter 9. You can do that anytime. And okay, so now next week is different than most weeks. First of all, Monday the university is closed. Woohoo! So we get a day off, right? And Veterans Day observation. So we do not have class Monday. And if any of you have looked at the syllabus, you know this next one should not come as a surprise to you either. There is no live class next Wednesday. No live online, no live in person. I am going to training Monday through Thursday, and I will be in Virginia, so I will not be here. So I am going to be recording what we would normally do in class on Wednesday. I tend to prefer to do those in smaller chunks. So I will put up an announcement with links to that, what Wednesday's class is. There will still be an attendance quiz next week, and it's over that. And I will make sure that I send you a complete email with the links and everything, and that will also be listed in Blackboard as well. So, so next week we are not here because Monday the university is closed. Wednesday we're doing an online recorded class only. So Wednesday next week will not be Blackboard Collaborate at all. It'll be available sometime this weekend, so you can do it anytime, and that's what we'll do for next week. And I will give complete email information in that email or that announcement that I email out. Okay, tutoring this week. We've had several sign-ups. There are a few spots left. I emailed yesterday about tutoring. You may have gotten 2 emails. So if you want tutoring, I would urge you to sign up. If you didn't do as well in the exam as you would like, I would urge you to come to tutoring starting now because she starts covering Chapter 8 and 9 this week. Okay, Exam 2 results. The average on the exam after the curve was about 71%. The scores ranged from 23.8% to 108% after the curve. There were 4 100% scores, and you can see the list of scores at http://tiny.cc/exam2results. You can see where your score falls within that range. There were, I do want to say there were a lot of really solid A's and a lot of solid B's. So with that in mind, I do want to say I would urge you again to see your exam with Brian. Sometimes I hear, I don't know what I did wrong. The answer to that is come in and see your exam with Brian. He's here today, 10 to noon. He's here Wednesday from 4 to 6 and Thursday, 10 to noon. And so he will be in room 579 in the College of Business. These are his hours to go over the exam. He normally doesn't have hours outside of class because of his other work duties. So, anyways, that's the time that you can see your exam with Brian. I emailed this out yesterday too. Okay. So then we're going to get started. Any questions before we get started with anything? Okay. Okay, so Chapter 8, as I already started with, Chapter 8 is a very, very short chapter for us. We have 3 learning objectives out of the whole chapter. Learning objectives 1, 2, and 6. That is it. You will not see 3, 4, and 5 in study plan. You won't be held responsible for them. So we are just doing 1, 2, and 6. It goes very quick. Today we should get through all of it easily. Okay, so what we're going to do is we're going to start with some questions, and these are pretty much true-false questions. You would have watched the Chapter 8 lecture, so these are some pretty basic ones. So we'll start with this one. GAAP, generally accepted accounting principles, requires companies to adjust their available for sale securities to market value as of the balance sheet date. True or false? Okay, on this one, I got an answer of true, and that is a great way to start a Monday morning. That is absolutely true. Available for sale securities are securities that companies have bought that they're holding out for sale, that they can sell them when they need the cash or when market conditions dictate. So available for sale securities is the largest category. Most securities, like stocks we own in other companies and bonds we own as investments, most are going to fall in this available for sale security category. So that's why we're focusing on this one. So when we have stocks, if we own stocks in other companies, we adjust them to market value as of the balance sheet date. Okay, so now we had, and we did well online, 13 trues and 2 falses, so it's true. On the balance sheet, so available for sale investments in stock are reported at what? A, cost, B, lower of cost or market, C, their amortized cost, or D, their current market value. We're out of camera range, but what do you say? You'd say D? Okay. Okay. You say D also? Okay. Okay, on the balance sheet date, available for sale investments in stock are reported at, and the answer is indeed D, current market value. Okay, so what we're going to do now is one of the 2 homework problems. This will go pretty quickly. It's not bad. We have a list of transactions. So we have 3 transactions we're given. And we have to, the first requirement here is to journalize the investment transactions. So we don't need explanations. We're just going to write the journal entry. So we have 3 transactions there. When you're preparing for the final exam, on that reference sheet, there's certain things that I would put. And these journal entries that we're doing here, these 3 journal entries, are pretty representative of what we're doing in this chapter. The first one is purchasing shares of stock. The second one is receiving a cash dividend. And the third one is adjusting to market value. Those are pretty much what we're doing in this chapter for this part of it. So those are good ones to have. So as we go, you might just want to note that those are good ones to know. Okay, so the first one, journalize our investment transactions So we'll start with April 10th. So April 10th, it tells us we purchased 600 shares of Tycon stock paying $17 a share. Okay, so I know right away that my journal entry is going to have to do something with $17 a share times 600, whatever that might be. So what I'm going to do, here's my journal entry. 600 times 17, that's 10,200. I'm going to debit my investment, that available for sale investment. Sometimes we write it as just investments or long-term investments or whatever it is, but that is an asset. So I'm going to debit this asset for the 10,200, which is the 600 shares of stock times $17 a share, going to credit cash. Okay, so this transaction, I'm increasing assets with my investment debit, and I'm also decreasing assets with my cash credit. So that's when we purchase an investment, that's what's going on here. We might call it investment in stock, we might call it long-term investment, but it's something with investments. Okay, so that's the first journal entry for the purchase of the investment. The second entry, July 22nd, we received a cash dividend of $1.24 per share. Okay, so $1.24 per share times 600 shares. We said we bought 600 shares, so $1.24 times 600, that's going to be the amount of this journal entry. We received cash, so cash is going to be part of this transaction. We're getting cash, so cash is increasing, so we're going to debit cash. So our journal entry is going to be to debit cash for $744. 600 times $1.24 is $744, and we will credit dividend revenue for $744. So we're increasing an asset and we're increasing revenue here because they're telling us we received the cash. We're not doing accrual for it. We didn't accrue for it. We're receiving the dividend in cash right now. Okay, so then the next journal entry, December 31st, we adjusted the investment to its current market value of $5,500. Okay, so we report this at its current market value. Its current market value is $5,500. We, though, have it on the books for $10,200. That initial entry we did, we purchased it for $10,200. It has a current value of $5,500. They tell us that. So we have an unrealized loss of $4,700. So that's the calculation we need to make. We said we purchased it at $10,200. We have a current value of $5,500. So we have this unrealized loss of $4,700. So the journal entry, so that $4,700, we're going to see that in a minute. It's going to go off the screen because I don't have enough room for everything. So that $4,700, remember that the word unrealized means we have not sold this yet. So we still have it, but its market value has changed. It's unrealized loss. Loss means it's less than what we purchased it for. So the journal entry we're going to see here then is to debit that unrealized loss on investment for $4,700 and credit our allowance to adjust investment to market. Okay, so then moving on, it says the next requirement says assume that this stock is their only investment. So that's just to make things simple for us. Explain how these transactions will be reflected on their income statement and its statement of other comprehensive income. Okay, so here, on the income statement, we'll have dividend revenue of $744. Now we have this other little thing called the statement of other comprehensive income. It's other things, so investors know that we haven't actually sold this. We have an unrealized loss on that of $4,700. Okay, of this statement, the thing that I would be most interested in you knowing is the income statement having a dividend revenue of $744. And then we have that unrealized loss belongs on this statement of other comprehensive income. It's a signal to investors that this isn't sold yet, that this is marking to market. I'm using you as my gauge for when to move on, which is a good thing. I'll ignore you now. Okay, I'm not looking. Are you done? Yeah. Okay. Okay, so next, for the next statement down, how to report the investment and any unrealized gain or loss on their balance sheet. Okay, so we're ignoring income tax again just to keep it simple. So on the balance sheet, what we're going to see is we're going to see assets. This is just where things go. This isn't a complete balance sheet. So we have assets, we have whatever our current assets are, but we have long-term available for sale investments of $5,500, and then under stockholders' equity, we're going to see that unrealized loss on investments of $4,700. It has brackets around it because it is a loss. If we had a gain, it would not have brackets around it. So this is just excerpts from the balance sheet where these things would be. So the investment of $5,500, the market value, is going to be under assets, long-term assets. That unrealized loss is going to be on stockholders' equity under accumulated other comprehensive income. Good. Good. Okay, so now we have a couple questions. This particular question, we're going to use the same data twice. So I'm going to pause for a minute, let you write down that little paragraph, and then we're going to change the question for the next question. So we'll use it twice to just leave adequate room. Okay, on January 1st, 2012, Plymouth Company purchases 100,000 6% bonds at a price of 90.4. Now, when we say price of 90.4, what we're saying is we're buying them at 90.4% of the face value. So the 9.904 times the 100,000 is what we're buying them at, and a maturity date of January 1st, 2016. Interest paid semi-annually, and they have a calendar year end. So it's asking us the entry to purchase the bond investment. So this is like that very first journal entry we did back on the homework exercise. We're going to be debiting investment, and we say is this a short-term or long-term investment. When we buy it January 1st, it doesn't mature till January 1st, 2016, so 4 years from now. So this is a long-term investment. So what we're going to see here then is we're going to see that we're going to debit long-term investment, okay, for the $90,400. How we got the $90,400 is the 90.4% times the face value of 100,000. And then what we're going to do in the journal entry, we'll debit long-term investment, we'll credit cash. So knowing that when you purchase an investment, you're debiting the investment asset and crediting cash, that's good to know. That's a very basic journal entry, not something you should have to figure out, but you just have it written down. If I purchase an investment, this is what's going to happen. Okay. Okay, now on to the next question. I believe, if I recall correctly, that it uses the same set of facts, it just changes the question. Yes, it changes the last sentence. So everything up to the last sentence is the same, but now we're looking for the entry of receipt of interest on July 1st, 2012. So when we get interest, what would we do? So we'll pause for a minute. You can select your answer, and then I'm going to do some polling. Okay. Hello. What do you think? Okay. Do you have the homework problem? The one we just did. Okay. I'm not letting you off the hook. Okay, so the second journal entry we did for the homework problem. So that would have been like this one right here? Yeah. Yeah. Well, let's see. Okay, so receipt of interest, we would have gotten cash, right? Debit cash for how much? So now it's a 50-50 shot, right? B would be for the whole year. Now look at the date. We have July 1st, and we bought it January 1st. So we're probably not going to get the whole year's interest. So by process of elimination, we'll go with A. See, it wasn't so bad. Okay. So we debit cash for $3,000, and how we get that, this is a half year's interest. We bought it January 1st. We're talking about interest on July 1st, 6 months later. So 6% times 100,000 times 6 months out of 12 gives us the $3,000. We'll be debiting cash, and then we'll credit either interest revenue or interest receivable, depending if we had an accrual for it or not. I'm just trying to give you the generic journal entry, what it's going to look like. We'll debit cash and then credit either the receivable or the revenue. Okay. Yes. The question is, anything over a year considered long-term investment? The simple answer, yes. The rule of thumb for 99% of the time, yes. A company can have an operating cycle that's longer than a year, and then that would be your period, but the rule of a year. Okay. Okay. So now we're switching topics. Two things you absolutely, positively have to know in terms of good things to know about time value of money. The principal is the amount borrowed or invested. I suggest you write this down if you don't know it right off the top of your head. Okay? Principal is the amount borrowed or invested. And then discounting is the process of calculating present value. So your present value, it's what something's worth today, and present value is always less than future value. Okay, so principal is the amount borrowed or invested. That's the usually it's the amount that you borrow or invest. Discounting is the process of calculating what something's worth today, which is less than what it's worth in the future. For example, if I get $5,000 10 years from now, that's not worth $5,000 today. I could invest, I'm just making up numbers here. I can invest $4,000 today at 8% interest and have $5,000 after 5 years. $5,000 is its future value, $4,000 is its present value. So the present value is always worth less than the future value. When we record things, when we're talking about time value of money and investments, we're recording things at present value. So discounting is this process of finding out what something's worth today. We know the future value, what's it worth today? Okay, so those are two basic concepts about time value of money that you will need. You will see questions on those. So there's that. Okay, now in your book, there are two time value of money tables. For our class, there's a couple different ways to do time value of money calculations. You can use the tables. There's equations that I do not suggest using at all just because they're kind of cumbersome, or you can use a financial calculator. Now the financial calculator will work fine on homework when you're at home. Financial calculator won't be allowed on the exam. I'm not going to require a financial calculator for this class for, what, a week of stuff. So we're going to use the lowest common denominator, which is the tables. You'll get a little bit slightly different answers using a calculator, a financial calculator versus the tables, but My Accounting Lab will accept either. So for purposes of My Accounting Lab, you can use the tables or a calculator. For your exam, you will have to use the tables. The tables are provided to you in My Accounting Lab. So if you need the tables for an exam question, they will be provided to you in My Accounting Lab as a pop-up thing. So you will always have them. So there are two tables we're concerned with. One is on page 487 of your text. It's the present value of a dollar table. This is used for single sums of money. The other one is on page 488. This is the present value of an annuity table. And that's when we have a stream of equal payments. And we're going to go through an example of when to use which table. The big thing with this is just being able to pick out, do I use the first table or the second table? Okay, so which table to use? The present value of a dollar table, that's when you have one sum of money. This example where I said I'm getting $5,000 5 years from now, I would use the present value of a dollar table. If, however, my grandmother said, I will give you $1,000 every year for the next 10 years, that's an annuity because I have 10 equal payments. I would use the present value of an annuity table. So those two tables are referred to: present value of a dollar table, present value of an annuity table. Those two tables are whether we have one sum of money or equal payments. So we're going to go through a homework problem where we have to pick out which table to use. Okay. Short exercise 8-9. Okay. So, short exercise 8-9, we calculate the present value of the following amounts. We have $10,000 at the end of 5 years at 8%. We have $10,000 a year at the end of the next 5 years at 8%. So we're calculating what these sums of money are worth right now. Okay. So, dealing with part 1. Okay, part 1, $10,000 at the end of 5 years. Which table to use? We have two tables from which to choose. What do we use? The first one. Yes, because we have a single payment. So we're going to use that first table because there is only $10,000 at the end of 5 years. This doesn't say at the end of every year. It's at the end of 5 years. So we're going to use the present value of a dollar table. Now, notice it says we're getting $10,000 at the end of 5 years at 8%. I'm going to leave this screen for a moment, but the numbers that we need to keep in mind are 5 years and 8%. Okay, so 5 years and 8%. What I'm going to do now is I'm going to the table. Okay, so the present value of a dollar table, so I've turned to page 487. Present value of the dollar tables, and I'm going to be looking at the 5 years, 8%. So the fifth period, that's the line that's underlined towards the bottom. So fifth period, I'll go across until I get to the 8% column. And when I get to the 8% column, I see a factor of 0.681. Okay, so 0.681. Now what I'm going to do with that is I'm going to take that factor and multiply by the amount of money I have, the 10,000. So I'm going to take 10,000 times the 0.681, and I get $6,810. That is the present value of $10,000 5 years that I'm going to get 5 years from now at 8%. Okay, so that's the first one. Now we're going to go on to the other one, and the other one is $10,000 a year at the end of the next 5 years at 8%. So now we use table 1, so now it would make sense to use the other table, but the reason we know that this is the present value of an annuity table is we're saying 2 or more payments equal amounts. We're getting $10,000 a year, every year at the end of the next 5 years. So we're not getting it at the end of 5 years. We're getting it at a year, per year, for each of the next 5 years. So that's an annuity. We call that an annuity. Annuity is a stream of equal payments. So we're going to use that second table. So what we're going to do then is we're going to go to the table on page 488. We're going to go to the fifth period, so this is 5 years and 8%, and then we'll see the factor is 3.993. Okay, so what I do is the 3.993, I take the 10,000, the amount, just the one payment amount, times the 3.993, and I'll get 39,930. Another way to look at this is if I put 39,930 in the bank right now, or in an investment right now for 5 years, and I earn 8% a year on it, I will be getting the equivalent of $10,000 a year for the next 5 years. So the present value of what that $10,000 a year for the next 5 years is worth right now is $39,930. We know that we're going in the right direction because $10,000 a year times 5 years, that's $50,000, but it's worth less right now because I can invest money right now and make money. So the present value is always going to be worth less than the future value, and the future value is what we're given here. Okay, now, okay, so now we've got some questions. I do want to point out, let me go back to this homework problem. I do want to point out that this is the second homework problem. You see how fast your homework will go this week? This is one that you'll get in, get it done, not bad. I would go ahead and start studying for the exam, preparing yourself, starting on chapter 9, because we'll have 9 on Wednesday. So anyways, those were the 2 homework problems. So this chapter, very small. Okay, so now another question. Unrealized gains and losses from available for sale investments arise from what? A, the purchase of an investment, B, the sale of an investment, C, changes in the market value of the investment, or D, management's decision to adjust the value of the investment. Do you know it? You think it's C? Okay. What do you think? C. Okay. I'm going to go over here and see. What do you think? See? What about you? See? See? Okay. See? Okay. Okay, getting a lot of C's here. And the answer is indeed C. So when you see the word unrealized, that's a trigger to you that these come from changes in the market value. Now I did add something to the bottom here. Note this statement I made, realized gains and losses. So if you see if it says gain and or loss and it doesn't say unrealized or it says realized, that comes from the sale of the investment. The only way you can have a plain gain or loss or a realized gain or loss is to sell it. Okay, so we see the word realize. That should be a trigger to us that we've sold it. If we just see the word gain or loss and it doesn't say unrealized, that's realized as well. Realized is the default assumption. Unless you see the word unrealized, we assume it's sold. But once you see the word unrealized, it means that it's just a change in the market value, that we still hold it. Okay. Okay, now here's one to think about. On the maturity date of the bondholder will receive the bond's present value, true or false? Okay, what do you think? False? False? True? True? You're originally going true, okay. False? Okay. Okay. Okay, what do you think? False? It's like 33 degrees. Too cold. Hmm? Too cold? Oh. Okay.
True.
True? Okay. False? False? Feel pretty confident about that? Okay. Okay. Got a mixture of answers. It is false. Present value is what it's worth today. Okay, that doesn't what we're going to receive in the future. Maturity value is in the future, so that's not what it's worth, not what we're going to get. So on the maturity date, the bondholder will actually receive the bond's face value. Okay. What did you have online? 14 through 9 falses. Okay, so it is false, so something worth noting. Okay. Done? Done? Don't leave. What's due this week? See, let me get to the next slide. Ha! Your lucky day. You're here. Yay. Okay. First of all, I'm going to redo what I said. Those of you who are on a computer in here, you can take it using your computer. We're going to push a quiz out to you. So if you have a computer, so we've got plenty of time. Okay, so if you're in here, I'm going to give you a paper copy in just a second. You'll hand it in to me on the way out the door. I know I saw 2 of you with computers. You can feel free to do it on your computer. Are you signed in to Collaborate back there? No? Okay, then just take it on paper. That's fine. Okay, then if you're online, and Haley's going to be doing this in just a minute. If you're online, if you're on a computer, Haley's going to push out a quiz to you. And that'll be just like the practice one if you were online a couple of weeks ago where we did a practice one. It's the same quiz as in paper, but it goes pretty fast. Then finally, if you're online using a mobile device, Haley will push out a link in a few minutes. Okay, Haley got ahead of the game. Okay, so yeah. Okay, so okay, so I am going to. You're going to hear me chatter. Let's turn off recording right now.